Sometimes the most powerful guide to investing isn't some dense, complicated textbook. What if I told you it was just a single letter written over 40 years ago? Today, we're going to unpack Warren Buffett's 1980 shareholder letter, and believe me, this is way more than just an old annual report. It's a timeless masterclass in how to think about money, and it is shockingly relevant to our world right now.
Now, to really appreciate the genius of this letter, you have to picture what the world was like in 1980. It was, to put it mildly, a time of economic chaos. Inflation was just roaring at over 13%, and get this, the U.S. prime interest rate hit a staggering 21.5%. People were terrified, Your savings are basically evaporating, and the future felt completely up in the air. This is the backdrop, this fear that Buffett was writing in.
And what did he deliver? Not some message of panic, not some complex financial trick. No, he offered a lesson in pure, simple clarity. This letter was his way of teaching his shareholders, and by extension, all of us, how to think rationally about business and value when it feels like the rest of the world is losing its mind.
All right, so let's dive into the first huge lesson from this letter. It's all about seeing what other people miss. Buffett introduces this incredible idea of looking past the surface-level numbers to understand what a company truly earns. He wants us to see the whole iceberg, not just the tiny bit sticking out of the water.
He makes this really crucial distinction between what he calls reported earnings and economic earnings. So, reported earnings, that's the official number, right? It's what the accounting rules say you can show. But economic earnings? Well, that's the real story. It includes a company's slice of the profits from other businesses it partly owns, profits that are being reinvested for them, but that never actually show up on their main income statement.
And here's where he drops his famous earnings iceberg metaphor. He explained that for his company Berkshire Hathaway, back in 1980, the earnings they officially reported were just the tip. It was less than half of the company's actual earning power. The most valuable part was all hidden beneath the surface, completely invisible to your average Wall Street analyst.
And these numbers were just wild. So Berkshire reported about $42 million in operating earnings, but their share of the retained earnings from all their other investments, the money being reinvested for them, was actually more than that. The invisible part of their iceberg was bigger than the visible part.
I mean, this is pure Buffett. He cuts through all the Wall Street jargon with this simple, brilliant wisdom. And the point is so powerful. Accounting rules might hide reality, but they can't change it. If you own a piece of something that's growing, that growth is real value to you, period. It doesn't matter if it shows up on a piece of paper or not. Economic reality always trumps accounting convention.
So if Lesson 1 is about finding hidden value, Lesson 2 is about a hidden threat that absolutely destroys it. Here, Buffett gives this really stark warning about what he calls the great invisible inflation tax.
To make this concept super clear, he uses this beautifully simple analogy called hamburger math. Okay, stay with me here. Imagine you give up eating 10 hamburgers today to invest that money instead. Over the year, your dividends buy you, say, 2 hamburgers. Then you sell the investment, and the money you get back can buy you another 8 hamburgers. So in the end, you have 10 hamburgers worth of purchasing power, exactly what you started with. You feel richer in dollars, sure, but as Buffett said, you won't eat richer. Your real return was nothing, 0.
And the number that was driving that painful hamburger math? 12% inflation. Buffett showed that at that rate, even a company with a fantastic 20% return on equity was creating literally zero, real wealth for its owners once they paid their taxes. The 1-2 punch of inflation and taxes just ate up every single penny of the gain.
And Buffett just nailed the feeling with this powerful metaphor. Investing during high inflation is like trying to run up an escalator that's going down and picking up speed. You're working harder and harder and harder just to stay in the exact same place. Inflation is the escalator, and taxes are like weights tied to your ankles. It's an incredibly tough battle to win. So if the world is filled with hidden earnings and these hidden taxes, where on earth do you put your money? Well, this brings us to Lesson 3, how to spot a truly great investment opportunity. And, just as important, what to avoid.
First, Buffett tells us what not to do. He is deeply skeptical of so-called turnarounds. He's basically saying that when a brilliant manager tries to save a terrible business, it's the terrible business that usually wins. You can't fix a fundamentally broken industry.
Instead, he makes this really critical distinction. He isn't looking for some chronically sick business that needs a miracle worker to save it. No, he wants a wonderful business with great economics that just happens to be suffering from a temporary, fixable problem. And his best example of this was Geico.
See, in the mid-70s, Geico was on the verge of going bankrupt. Everyone was running for the exits. But Buffett saw that its core advantage, its low-cost structure, was still there. It was still intact. The problem wasn't the business itself. He called it a localized, excisable cancer. It needed a skilled surgeon, absolutely. But the patient itself had incredible DNA.
And the results of that diagnosis? Just phenomenal. For a total cost of only $47 million, Berkshire bought a claim on roughly $20 million of Geico's earning power every single year. That's an initial return of over 40%. It's the perfect example of buying a first-class business at a third-class price.
So when you put all these lessons together, the iceberg, the inflation tax, and the Geico story, what you get is a clear, powerful, and truly timeless playbook for how to think about investing.
And here it is, the Masterclass boiled down to 4 key principles. 1. See the whole iceberg. Focus on a business's real economic earnings. 2. Never ever forget that high inflation is a destructive tax on your money. 3. Hunt for those wonderful businesses that just have a temporary solvable problem. And 4. Stay away from bad businesses. It doesn't matter how great the manager is, they almost never get fixed.
And this all brings us to a really critical question for all of us today. We live in an age of 24/7 news cycles, of algorithmic trading, and just constant noise. In this environment, isn't this patient, clear, first principles way of thinking that Buffett laid out all those years ago, isn't it not just relevant, but maybe more valuable than it has ever been? It's definitely something to think about.
Before you go, one quick thing. If you found this video helpful, please consider subscribing to our channel. We're building a community of people who want to think differently about money.